Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, February 2nd, 2024, Groundhog's Day. S&P 500 currently sitting at 49.50. I'm here with Ian Price McMillan. I'm David Zarling. And this is one of those episodes where I don't know if we're going to last 20 minutes or an hour and 20 minutes, Ian.
Yeah, I guess this shouldn't be we have a trend following podcast. So
Yes, we do have a trend following podcast. We follow the trends of price, and that trend could be different in different spots.
Most of the trends continue,
which is what trends do.
Technically you've got S&P. Yeah, a little bit of Tuesday, Wednesday were a little rough. Maybe a little bit of a rebound yesterday, at least from, our trusty friends, mega cap growth. And then today, on the back of what seems to be, so far, good earnings reactions.
Yeah, let's talk about that. When we think about earnings reactions, because I think it's pretty fair to say that most people listening to this that are familiar with listening to it understand that really we could care less what the earnings are. It's the response to earnings. And where are we at with that? We had a lot of the mega cap names report this week, whether it was Google or Meta or Amazon. What are we seeing out of some of those mega cap names from a price response perspective, which is near term? I get it. Like, we could talk about these things weeks later as well. But what are we seeing initially from some of these?
Yeah, they seem to be bullish. I guess people like I don't even know what the numbers were.
Yeah, I don't know what the numbers were either. But like, for example, I know Meta gapped, 15 or 20% overnight from last night to tonight. On the flip side, earlier this week, you had Google gap down. And so that's why these it does make sense to pay attention to some of these relationships. Like if you look at Meta versus Google, there's a chart there. And I encourage anybody listening to this that likes to look at charts to do that comparison, because I think there's some insight there. When we look at the month of January, so we're fresh off of a full month of information for 2024. We had a negative Santa Claus rally period. So that's the last 5 trading days of 2023 and the first 2 trading days of 2024. That was negative. The first 5 trading days of January was negative, and I'm using S&P for this. But January was positive. And so now we're in this coin flip territory of that doesn't necessarily mean bad things. It also doesn't necessarily guarantee great things. And so we're in this environment from a seasonal perspective where coin flip on how the year turns out. If you're going to give a nod to one of those 3 out of the trifecta, you're going to give it to the January barometer, the full month of January. S&P 500 positive, small caps negative.
Yeah.
So does it continue to just be a mega cap?
Stuff. Yeah, there's a lot of stuff negative.
And I think that brings up a worthwhile, I know you shared a chart internally regarding the market cap weighting of the S&P 500. And to paint that picture for a new listener or maybe a client who's listening who is asking the question, what do you mean by cap weighted? When we look at the traditional sense of the S&P 500, it's those companies that are larger in capitalization that carry more weight in the index. So it's not equally weighted. For example, Microsoft is the largest constituent of the S&P 500. It dwarfs certain sectors. Like the way Microsoft moves might impact the index more than something like energy or an area like real estate. When we look at that, there's a lot of information that can be gathered from comparing the largest constituents versus the rest of the index. Our clients are familiar with our presentation last month talking about how 71% of the S&P 500 index underperformed the index itself. So how does that happen? Well, it's because the largest cap pieces are performing the best. And that's normal behavior. It's kind of like, are you really that surprised to see Pat Mahomes in the Super Bowl? I'm not. And so what are we seeing from the chart that you shared internally? What are we seeing there from the largest 10 stocks in the S&P 500?
They continue to be a pretty large weighting. I think we got the new highs.
Yep, new highs. What I think is fascinating is when we talk about the largest 10 stocks in the S&P 500, they're 33% of the index currently.
Yeah.
That's about as high as we've seen since the 1970s.
Mm-hmm.
And could it go higher? It absolutely could. And this is where I'm going to throw a curveball, Ian, in our discussion today, is that chart that you shared goes back to the mid 1960s. In that chart, you see a declining of the largest 10 starting in the mid 1960s. Makes me wonder about the 1950s and early 1960s. Here's where I'm going with this. So our listeners are familiar that we've talked about a change in the interest rate cycle. The last time we saw a change where we were going from rates being lower to rates being higher was in that time frame, the late 60s, early 1970s. Leading up to that, however, was a rising rate environment. Your 40s, 50s, and 1960s was a rising rate environment, and you saw mega caps carry the day. And is that really what we're seeing now? Is this going to be an environment that we know for the next 10 years that is about, it was called the Nifty 50 back then. It wasn't talking about India stocks. It was talking about the largest 50 large cap names. Is that what we're experiencing now for probably the next 10 years? Time will tell, but do you have any thoughts on that?
I think it's pretty possible. We talked about last week, the NASDAQ, we look at the correction in, I think it was like the summer, fall 98, and NASDAQ was back to all-time highs by November of that year. And the Russell didn't get back to all-time highs until December 99. So participation, I'm sure if Twitter was around in the late 90s, there would have been a lot of angst over participation and everyone would post their breadth charts. I know I post breadth charts too, but it goes back to the, at the end of the day, price is price.
Price matters most.
And not the best participation. I get it. The average stock's still pretty lame. And we are going on close to 3 years of this. So, yeah, there's a lot of frustration out there unless you want to own the NASDAQ or, a handful of stocks. And yes, I know, again, people are, well, there's more than 7 stocks. Yes, clearly 7 stocks going up. They have zero impact on the major indices. So, they have very minimal impact on what the indices do.
The way they're made up.
Yes.
And that even gets back to like somehow the ETF construction, the world of creating ETFs matters because the only way you can have concentration to the level that we're seeing out of something like the S&P 500 is if it is an index.
Yeah.
So we're now exceeding levels when you talk about growth and tech stocks being well over 33, 34% of an index. That exceeds even some of the ETF requirements that our own government regulators put out. And that's not a complaint. That's just saying this is how the index is made up. And when you consider that last year, 71% of the S&P 500 index underperformed the index itself, that it's really easy to understand. The mega caps
how much?
are the ones
71?
71% of the S&P 500 underperformed the S&P 500 itself, which tells you.
I wonder where that ranks historically.
It's number one in the last 20 years. We've never seen anything like it. And that's where I go back to the 1950s and 1960s was this Nifty 50 era. Are we seeing that unfold again? Are we in a 1950s scenario where it's these mega multinational companies? Because, right, we're talking about Microsoft. That's used everywhere. We're talking about Apple. That's used everywhere. Google, it's used everywhere. These are not just U.S. Yes, they're U.S. based, but they're not just used in the U.S. like a lot of the small cap names. And so when you look at like performance for the start of the year, when we look at monthly information, so January, S&P positive, NASDAQ 100 positive, carried by the mega caps, small caps negative. And when you look underneath the hood of something like the New York Stock Exchange as a whole, We haven't had one day in 2024 above 75% of stocks moving to the upside.
Really?
Yes. So when you look at breadth from that type of perspective, really you could make the argument that since late December, a lot of stocks have been in corrective mode. And because of the cap weighting of the indexes, it's hidden that type of correction. So if you look at like upside volume versus compared to downside volume in the NYSE, we haven't seen a plus 80% since mid December 2023. So we're about 45 days removed from that. So underneath the surface, there's this current of correction, and that's okay. I'm not here to say that that can't be the case or it's bad that that's the case. It's just the reality of the situation is that the mega cap names continue to carry the day. And do we get to be surprised if they continue to do so? We don't. Could 2024, as you've alluded to in the past, be more of the same as 2023? Well, that's what markets do. They tend to trend. Do we see a 2024 where mega caps are the story for 2024? So far, that thesis is not refuted.
No. I also wonder, when did we get the Whaley breadth thrust?
That was in that whole sequence of the flush in October, late October.
Early November.
Early November, right? There's the panic selling followed by the panic buying. You tend to see when these like Whaley breadth thrusts, Wig breadth thrusts, these are mathematical formulas for determining how you went from a really extreme oversold to an overbought, where there's a flush and a rebuying of the market. These are very healthy. They also have characteristics, though, where if you think about November, December, January, depending on what you're looking at a 3-month move of about 15 to 20%. When you see these breadth thrusts, they're long-term very, very positive, like 6 to 12 months, but near-term a little bit exhaustive.
And that's what I think a lot, and myself included, although I am the one bringing it up. But I think a lot of people could do better to keep that in mind. So, right, we get these Whaley breadth thrusts, and everyone rushes to post their, and I think I had one on, it was more of a price thrust on the Russell. It was like a 9-week move on the Russell 2000 or something. And we zoom out and we show the data and we're like, oh my God, over the next 6 months, 12 months, 24 months, 3 years, like look how bullish it is. And then within 2 weeks, go right back to this super like short-term mentality. And it's like, well, wait, I thought we just got done all agreeing that this was like really bullish over the next, pick your time frame. And I'm guilty of it too.
No, you bring up a great point because you're talking about the comparison of different time frames. So the price action and the behavior of the market in November and December is extremely, extremely, like you couldn't set it up any better, constructive for the next 6 to 12 months. But yet we're also allowed to say that currently we have a narrowing of breadth. There does seem to be a correction happening underneath the surface. Seasonally speaking, we tend to see weakness into mid-March, and that's okay and still keeps the broader picture intact of an uptrend upon us, a potential of a new bull leg, and that any type of corrective behavior into mid-March would be counter trend. So corrective within a bigger picture uptrend. Is that what you're saying, Ian? Is that we could correct for the next 45 days, but that's still perfectly healthy for the market overall?
It is, and it stinks, right? And we talked about this a little bit. The Russell 2000 hasn't done anything for 5 weeks. This was last week's podcast, but right. It was still leading off the late October lows. All these defensive areas still up, but underperforming. But things get so like myopic on like a day to day.
Yep.
And we forget about, well, we really, 2 months ago, we got like an insanely bullish signal that says you should be pretty, over the coming months and years, market should do pretty well. We broke the all-time highs. We have an upward sloping 200 day. So, yeah.
No, I think that's a great
outside
point.
Of the Russell. I say that all of that is true outside of the Russell 2000. Still got to steer clear of those things. And it can be an issue. It can be an issue for years. And the Russell, or the Russell 2000 can go sideways for the next 2 years, and the NASDAQ can go up 150% because it's happened before.
Yep.
So,
and you got to be aware, and that goes back to that 1950s, 1960s thesis, all happening within in a rising rate environment. And at the same time, when I look at things and I say, okay, when you look at a comparison of XLK technology versus IWM, you're right up against important levels where you could see that relationship change. You brought up just IWM, for example, versus S&P, leading since the November bottom, November of 2023, in that relationship. We broke down in that relationship today, but you could also see that this would be that final exuberant move out of mega cap tech for the next 45 to 60 days, where I would make the argument, if you're chasing here, if you haven't been involved and you're sitting here going like, now's the time I'm going to get involved in mega cap tech, that's risk.
There's not a lot of reward in that formula. However you want to draw it up on your chart. But yeah, buying Meta on a 14% gap up is, now the reward might be great.
Right.
But the risk is also great. I'm just saying your factor there, your risk to reward ratio, not ideal.
At this point, could I, because you brought up Meta, could I go against my own preaching on our team and put on a fundamental hat for a second? Will you allow it?
I'll give you 30 seconds.
Okay, real quick. 1950s and 60s, advent of computers. So these companies have these mega computers that they're like.
What was it called?
1950s and 60s. They got these mega computers, like these rooms.
Mega computers. Okay.
Yeah, I don't even know if that's a real term, but I just mean like it's a room that has the same processing power as what we would now have in our phones. But at the time, it was mega processing power.
Okay.
And the only ones that could afford that were the mega companies, the big ones, the Nifty 50. Are we seeing that unveil with the advent of generative AI? That we're in this new era of the companies that can employ and afford to throw billions of dollars at generative AI are the ones that gain the competitive advantage, similar to the supercomputers or the mega computers. Because I think mega computers, to your point, it's going to be hilarious that I even said that. These computers that fill up an entire room or a basement of a company back in the 1950s is similar to those mega companies that can throw billions at generative AI. And there's that differentiation for the next 15 years.
Yeah.
I don't know where we go with that, but it does seem to be something that's on our doorstep, is the concept of generative artificial intelligence is something that is thematic with a lot of these mega cap names, Microsoft, Apple, Meta, Google. They're all talking about their language model, the artificial intelligence that they're trying to implement. You're not hearing that from your small cap names. So it's an interesting thought. I'm not necessarily going anywhere with that. You could be like, Dave, why did we just waste 2 minutes?
No.
So that could be the advent of what we're seeing. Again, that would be a fundamental narrative, and we don't like narratives. The price narrative is just simply lower left, upper right remains to be these large cap names, whether you like those names or not. And
whether you're tired of hearing about them.
Mm-hmm.
I mean, I don't know what to say.
I'm sure there's some people that are tired of hearing about Pat Mahomes and Travis Kelce and Taylor Swift, but what are you going to do about it? They're in the Super Bowl. It's the reality. I don't sit here and go, well, they shouldn't be in the Super Bowl because of that. No, they're most likely in the Super Bowl because they're good enough to be in the Super Bowl. Same with the NVIDIAs of the world, the Microsofts, the Metas, the Amazon. These are the things that are big, that continue to get bigger. These are the all-stars of the market. Could there be a correction happening underneath the surface? Absolutely. But do we get to argue with that? Because isn't the rest of the NFL in corrective mode right now? You got two teams. Everybody else is sitting on their couch.
Yeah, I think my big point is you might not like what the uptrend looks like, and you might not like the participation, but it's not a reason to, sit out. Just like I would, politically, it's not a reason to not to participate in, if we're in an uptrend, you want to participate. Like, who cares why the indices continue to go up?
Yeah. I mean, and do you get to be mad at the makeup of the index?
Yeah, don't miss out on a another, and I don't know how much stocks will be up this year, but let's say we get to December 31st and the S&P was up another 15-20%. Don't miss out on that because you were pissed off that the rally didn't look or feel like you thought it should.
And we're also fully aware that talking at the point in time, that there's still an environment where by the Ides of March, we're seeing the rest of the market firm up, i.e. small caps. And that's what carries us the rest of the year. As always, there's always multi-thesis on the table that are looking to be confirmed and refuted. And so, for example, right now, S&P 500, NASDAQ 100 above their previous highs back in 2022. We're at fresh new all-time highs. We're coming off of this earnings season for the mega caps. Most of them are responding heavily positive. Underneath the surface, you have small caps still below 200 or 2,000 using IWM or Russell futures. You pointed out before we started the show that micro caps are still struggling with this flat to falling 200-day moving average.
Yeah.
Your average stock is still not performing that great, but the table is also starting to get set for that second part of the year where those things do firm up and carry us forward and there's a rotation. So you have to be ready for that. And that's why you use charts. Like you can't just do that on a whim. You can't do that on a guess. It's why we use technical analysis. It's why we study supply and demand. It's why you look at a chart of something like IWM versus SPY, small caps versus S&P 500. That tells you when does it make sense to get involved from a risk reward standpoint. And Ian's point to where this started is why fight the mega cap story until it's time to switch. Right now, it's the mega cap story. That's it.
Continues to be days here and there.
Well, it's still happening
but
it's still happening within the context of what you're saying. Well, yes, we're seeing something like IWM versus S&P move lower today. It's also moving into a very, very interesting area from where the breadth thrust happened. So connecting those two dots, the expansion of breadth that took place in November with the Whaley breadth thrust and the Zwig breadth thrust, that was early November, mid-November. We're now seeing price on a relative basis of small caps come back to that level. It will be telling to see if buyers on a relative basis show up here. Will the demand for small caps start to outpace the demand for mega caps at this point in time? Time will tell. We have to wait till next week. It's kind of like you got to stay tuned in.
Join us on next week's episode.
That's right. You got to listen to Weekly Trend again. So we spent a lot of time on mega caps and small caps. Anything you want to highlight in any other area of the market? We just came fresh off of a month of, monthly candles. We still have seasonality in play. We haven't talked bonds or commodities or international stocks or crypto. Where would you like to take us for the next few minutes?
The dollar having a strong day today, so obviously that's had some ripple effects, I guess. Foreign stocks still pretty strong, or still pretty weak. Russell 2000 pretty weak. Gold, I think gold miners hit new 9-year relative lows against equities. Silver miners down there as well. So precious metals arena continues to be pretty bleak.
You brought up something really important.
Is platinum considered a precious metal?
Say that again.
Is platinum considered a precious metal?
Yeah, I think that's one of those industrial / precious metals.
Okay. I think it's doing pretty bad.
Yeah.
Metals in general, rare earth metals. I haven't looked at copper. Speaking of, it's kind of just hanging out. New relative lows, but hanging out on an absolute basis. So
industrial / base metals, along with precious metals, nothing really to see there when we think about this seasonal period of where we could potentially be weak. And, because February is notoriously a weak month out of the strongest 6 months. You tend to see weakness in February heading into mid-March. When we look at that and you look at the performance of staples, what do you think of staples from a performance standpoint? Any evidence there? Anything that
what everyone wants them to do?
What is that?
Going up slower than the broad market?
It's worth paying attention to, yes, when staples move higher. Yeah, we want to look at that, but it's really about that relative performance. So if staples are moving higher, but they're doing less so than the rest of the market.
Yeah, people were pretty pissed off. What was that, the 24th, January 24th? people were pretty annoyed because I think like didn't McDonald's get hit really bad that day or something?
Could be. Your Procter and Gamble, your McDonald's, your staple type environment. And this goes back to, and you've described this well in the
Costco
past,
and
Ian,
Walmart.
is that if staples are moving higher on an absolute basis, but at a less degree on a relative basis, that is really quality market information. When you tend to get concerned, and you've highlighted this in the past, Ian, is when staples are moving in a downtrend to the downside, but they're moving at a slower rate to the downside than the rest of the market. That's really when we need to be looking at that, correct? And we've
I
seen
wouldn't
staples.
worry about. I mean, Staples, from what I could tell, as a whole, yeah, doing exactly what you would want.
Now, if
in
you're
a
going to
healthy-
tell
in a
me,
healthy uptrend.
if you're going to look at staples versus the S&P, and it's going to be above, and I'm going to get real mathematical here, but 0.0153 in that relationship, if you're above that, then yes, we have some type of corrective market overall going on where we're favoring holding the things that are going down the least over those that are going down the most. I'm fully open to the idea that this mega cap earnings season marked a very pivotal time for the near term perspective. So in the backdrop, you've got the breadth thrust and price thrust that we saw in November and December of 2023 that signals typically strong returns 6 to 12 months, 18 months out, that we could be in a near-term phase. We would know we were in that near-term phase of corrective behavior if you're seeing XLP versus the S&P above 0.0153. That's definitely a possibility. One thing that's interesting that we haven't talked about a lot is like transportation stocks. What are we seeing out of those? We typically like to see transportation match what's going on with industrials. Anything notable happening with transportation stocks?
Underperforming
On a relative basis.
Yeah.
And so that's noteworthy. That could be information as well. It's also when I look at something like the Dow Jones transportation average versus the Dow Jones industrial average, we're really at a horizontal level where we see transportation start to return to leadership in that relationship. Does that have to happen? It does not. But you shared a really nice chart of something like Union Pacific or some of these railroad names that look like they're setting up for moves higher. That would be pretty constructive.
Yeah, ODFL looks okay. You buy ODFL.
So that's Old Dominion.
Yeah, you can definitely buy that.
So trucking.
That's not advice.
It is not advice. You're just saying, look at the chart.
I'm just saying.
Correct. We do not do that on this. He's just saying when you look at Old Dominion Freight Lines as a trucking company and you look at the consolidation that's taking place.
Right into that 200-day.
Right in the prior highs.
Having a nice day today. I don't know what Saya looks like. There's probably some dude in the trucking industry listening to this, and I'm pronouncing it wrong. But trucking is having a good day. XPO, look at that breakout. Big day for trucking.
So you've got railroads setting up really nicely. You've got trucking breaking out of lots of bases and consolidations. And in some ways, you can make the argument that transportation is now confirming what's happening with industrials, the old Dow theory, if you will. That is constructive information. And this goes back to, I'll say this, if now through mid-March is supposed to be weak, quote unquote, supposed to be because of seasonality, and we don't get that, the ramifications of the rest of the year are extreme. When you are supposed to get snow and you don't, you walk outside and you can be wearing shorts, we should pay attention.
That's true.
Same thing in markets. If we do not get corrective behavior now through mid-March, that is very significant to what the performance of the market could be for the rest of the year. And I think it's really interesting highlighting these trucking stocks and transportation stocks, what they're doing in the last few days, resolving higher out of these consolidations that go back to mid-2023. That's important to pay attention to. And so we'll see. We'll see if there's an echo in behavior in breadth expansion in the days and weeks to come.
Maybe the market's pricing in. We'll get a new transportation secretary.
Could be.
Better than that dude that's been on paternity leave for 2 years.
Could be.
Whatever. It's not weekly political trends. I'm sorry.
But it's a good point because, we highlighted in the lunch and learn that you can have whatever your favorite party is. The returns are the same. Now, what happens underneath the surface can be different, but it's noteworthy to look at uranium stocks. Uranium stocks continue to move higher. Coal stocks continue to move higher, while your clean energy and there's been some, I'll call it perkiness in marijuana stocks recently, but
Yeah, they're
nothing.
trying, but we've done this a lot over the last few years.
Yeah. And so
Solar just hit new relative lows.
Right. So if you think you've got the themes figured out for whoever's in power.
Lithium, remember lithium batteries were going to be a thing? Horrible. They've given up their entire. So at one point, off the 2000 lows, lithium stocks had outperformed by 165% going into late 2021. And they've basically given all of that back now.
While the broad indice returns are on average the same for each party, whoever has power, the best scenario is if we have gridlock, if we have divided power in Washington, right? And that makes sense when you think about no one has the rules to the board game.
Yeah, neither side can screw us too much.
Right. But underneath the surface, there's definitely themes that don't match what you think. That's why we don't follow financial news, right? If you had said to someone, yeah, once President Biden takes office, we're going to see clean energy and pot stocks tank. That's not the narrative you would have heard from us because we use price charts, but it is a narrative you would question because I'm sure the financial media would be covering it a different way. And the same thing will be in this upcoming election. Is from a broad indice perspective, you're not going to see some type of advantage. Will there be something underneath the surface? Absolutely. There'll be relative strength charts that we can use to identify where weakness is and where it's not. But here we sit, Groundhog's Day 2024, and it's the same strength picture, right? We're seeing the same thing as we saw a year ago, which is the mega caps lead. We haven't even talked about interest rates, haven't even talked about commodities, and some of that has to just do with interest rates haven't changed much over the past year. And that's okay. That can be good for markets. When you look at commodities, I think you highlighted, Ian, that oil went out to new relative lows.
Yeah.
You can have any type of opinion.
Energy stocks still relative downtrend. I mean, everything outside of tech and communication services.
Yeah.
I know you had Amazon gap up today, but discretionary still pretty rough as a whole. On a relative basis, so can't really own it. Financials took a hit. We had some regional banks get hit this week, which
can you talk about that?
I don't know really what happened other than some regional bank had bad earnings, I guess.
And what's going, if we can take our listeners back to March of 2023, you have the largest downside move in regional banks and financials in a decade. The impetus behind that is supposedly the fixed income or the instruments that they have on their books that they have to mark down. So, and it's really a regional bank situation. You had New York Community Bank take over the deposits of Signature Bank, and that's the bank that got hit hard this week was New York Community Bank. So is that piece over? Time will tell. We're not here. We don't know that answer. It is a regional bank. Can NYCB, a New York Community Bank, impact the indice like Meta? It cannot. And so there can be carnage underneath the surface that is happening in certain areas of the market. And that's just markets. I don't mean that to be callous. I'm sure there's good people working at these banks. And from what we can tell, banks are still trying to navigate this, both from a labor force standpoint and interest rate standpoint. And that, as markets always do, they tend to navigate and resolve out of that. Does that carry over into other markets? It could. I mean, European financial banks had been strong. They're kind of flat since mid-December. At the same time, you've got Japanese banks like MUFG that are doing well. So time will tell. Is it an echo? Was there an ongoing quote unquote crisis that happens in regional banking? No idea. We'll use price. All I will say is that NYCB was in a downtrend before that happened.
Yeah.
Anything else, Ian? Anything else you want to touch base on before we close this one down?
I don't have anything.
Okay. Well, I appreciate you being on here. I do like to highlight those who support the podcast, including Adaptive Select ETF listed on the NYSE under ticker ADPV. ADPV helps investors access two of the most prevalent factors in markets, momentum and relative strength. Through proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. As always, investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. Ian, it's great to have you on here again this week. We have to wait another week for the Super Bowl, so I guess we just got to wait.
Yeah. Got to wait 2 weeks to talk about it.
I know, it's crazy. But thank you for your time and your insights. Those that are listening, we appreciate you guys as well. If you value these, if you like listening to them and you think they're worthwhile, please like, share, give them 5 stars on whatever your favorite podcast platform of choice is. We really appreciate it.
Have a great weekend, everyone.